Hello, everyone. I hope you had a great 2 weeks and a great day of trading. The market is pretty insane. Each of us will go through what we have done and these past 2 weeks and what we are doing currently, what we are seeing, maybe macro-wise, signal-wise, etc. So first, I would like to go to Christopher to share what he's seeing. In the market currently.
So, all right, then I quickly share my screen. What I basically want to present is some countries which are currently very interesting to me. Basically, these are the macro regimes I like to track on a weekly basis. For Europe, we're seeing that growth is picking up again based on market measurements, which is most likely driven or basically driven by stock returns. So as you might already have seen in the markets, they're up quite a lot. So I track the quarterly changes, and they mostly have a significant influence in the model. So these things measure growth probability is upwards of 70%. Inflation is also reaccelerating based on the current setup on the weekly regime probability, but these things kind of changes a lot based on the volatility of the data. But under the current sentiment, it's likely to see another uptick in inflationary numbers for the US. We're still seeing a disinflation where it's the direction of inflation is going down. There's no doubt about it. You can see it in the year-over-year numbers. I like to track leading indicators as a measurement for growth. If you have looked at my blog post, I explained it there and why it kind of did not work in the last years, basically for the inflation measurements and for some growth outputs. But currently, the systems detect that USA is still in a disinflation. That means growth down and inflation down. For Germany, we're seeing a real growth, real growth environment, which is really strong at 95.3% for several months now. This you can see in the DAX. This thing has a good track record for the past weeks, which was quite a good long. For Brazil, same thing. Current data structure gives me a real growth environment. China is not going into a growth environment. I will focus on another report on China. So I like to track some energy production and some coking plant utilizations, which often leads or build the fundament or build the foundation of the growth output structure in China, which is quite interesting. Sweden, again, disinflation. This thing is my beloved country, so data is getting worse, but this thing does not correct as I wanted or it to be. So I'm going to track this for the next months. And again, Chile, which is a good exporter of copper, which is also in disinflation. So this could show that global growth could stall a bit for now. But as I would like to go into a little bit deeper into within the next slides on what I currently think about macro topics and what drives most of the recent strength. So first of all, I like to continue with a simple feedback economic chart. So this is a top level structure of what I would like to use. So this is the aggregate demand cycle I like to track. You can think of feedback economics like mental models in your brain, which get measured via a system like Vensim or Minsky. You can model these things. What I basically want to look at is demand supply. It's feedbacks, either positive or negative, with inventories, or price index and capacity utilization, which you can somewhat see on my blog. But what, in my opinion, drives the current or the recent strength in markets is the flow of funds picture, which is a kind of complex structure of government spending, consumption, income, investment, wages, and taxes. They all interact with each other, either positively or negatively, which is quite too complex for this short overview here. So in my opinion, recent strength is driven by heavy government spending. And you can see this throughout Europe. You can see this in the US. You can see the numbers of deficit spending. You can track daily or monthly treasury statements in the US. You can track quarterlies for Germany, for instance, and they all paint the same picture. They all spend with a heavy deficit, which is near to the GFC, which you will see in the next chart. And for Germany, it's the biggest deficit since 25 years or 30 years. So it's crazy. And it really influences directly the aggregate demand picture and further influence and supply, therefore capacity utilization. And this thing follows through the whole economy. And I'm not talking about interest expenses, which could also have a big impact on supporting income, especially for some bondholders or for some companies, where they get through increases in interest rates, they get their additional income, especially. I'd like to point out, which I already said, to some guys from MNT, which called this brilliantly. You should check these definitely out. So even if you're not into their economic models, it's always good to have some contrarian opinion and to be open to new ideas. So yeah, they called this brilliantly. And what I would like to focus now is, so in the top chart, you can see two leading indicators. So you can see from the blue one is from the OECD, and the green one is from the Conference Board. It's the leading economic index. And what you can basically see is that these two charts, they trend downward, which often signals growth cycle turns. They have a pretty good track record, but what's different this time is that we are running a deficit, and it's the green line and the subplot here, which are normalized with a C-score. So I used the 12 months running sum, divided it by real GDP at chain prices to get a measurement for deficit spending as percent of GDP. And you can see that the last point here, we are running a current deficit for the US, which is close, or basically close to the deficit run in the great financial crisis. So, and this whole apparatus in the last 2 years, if you think of government spending as both a leading and a lagging indicator, which is basically which you think of where the money gets deployed at the end, you can see that the structure, we are running a deficit. This supports the economy directly. It influences through this top level feedback structure by aggressively stimulating aggregate demand in the outcome, and therefore runs up GDP as well as therefore stock prices, which closely monitor the economy. So in my opinion, this is something we should all track, and it's rather simple to get these numbers, and it basically helps to explain that why we are seeing such strength in labor and the recent surprise in housing, and why we are not in a deep recession or in a recession where credit lending service might where credit conditions get and credit installment or anything else with credit does not have the current effect it usually has because of the heavy deficits where the government is supporting the current growth in the economy, or basically the not recessionary status in the economy. And this is what I wanted to say mainly, and for macroeconomic and stuff. And now I'd like to give you an overview of some of my models. And I like to point out in my blog recently. So you can see these are mostly all country ETFs. So you can see quantiles. You can look at some of my blog posts where I explain these quantiles or these numbers more clearly. But what you basically need to look is the trend column. This trend column is a midpoint of a Donchian channel. This channel I like to optimize based on a searching algorithm where I use crossing points and maximizing return. So the algorithm searches for the best time windows between 63 days and 180 days and gives me a midpoint where the price is above the midpoint, it's bullish, below it's bearish. So what you basically can see is that we're getting a lot of bullish signs, and these things don't change. It's now been 3 weeks where I see this trend column is mostly green and nothing really changes, even if some of these quantile prints suggest a correction. They mostly do not change anything in the trend outcome. Yeah, you can screenshot this or look at the video afterwards to see to look at upside downside ratios for my model, or the overall quantiles, which measure the forward 15-day returns. So something else I would like to share is for the model for Qs and for SPY. And what I'm looking at is that we are seeing a decent run up in prices where we are accumulating some downside. If you look at these ranges, which are simulations of my model, and we are seeing for a couple of days now that these upside downside ratios are skewed towards more downside. So in some ways, we should see a either sideways correction for some time now, which the quantile 3, these yellow, these white dots here point out to, where the mean expected return is closely to a Brownian motion, to a expected zero mean. And yeah, but overall, I don't see anything relating to trend changes right now. So there's really nothing given, because everything above here, these Lyapunov exponents, they measure exponential diversion. They're stable. These entropy measures are also relatively low, so nothing unpredictable. And overall, for me, this is usually a sign in the model that we should either see a continuation of the recent price structure or a sideways trend, but nothing non-linear or nothing of a heavy correction at this time. But we will see what the data will say in the next 10 days or 5 days, because as you all know, in markets, things can change rather quickly. Yeah, and that's everything from me.
Thanks, Chris. So interesting stuff, especially people used to say don't fight the Fed. Now, based on what you provided us, is don't fight the government, because regarding their spending, it's proven not a good bet. Okay, I'm gonna go first, Bryan, and then I will hand it over to you. Okay. So let's go to share screen. Okay, give me a sec to adjust. Sorry. Okay, we should be good. Okay, so I wasn't there 2 weeks ago. Sorry, my son was born, so I was a little busy. Unfortunately, I missed the spot to cut my positions, so which were pretty bearish. So in the last show, if you remember, I addressed the recurring theme of the crossover between trade and trend for VIX, and the fact that since we entered the bear market in November 21, anytime this happened, you had the start of the bull run in VIX, therefore the correction in assets. This thing didn't happen. So on the 1st of June, I believe it was, this setup was denied for the first time since November, and I actually should have cut my position there. So I didn't. I let my bias overcome my good judgment, and now I'm basically waiting to see when this I will call it bull market will stop. So I've said that before on Twitter. The structure moved to a bull market on the 1st of June, after a little before, actually, around the 26, 29 of May, after I denied the possibility for VIX to repeat what it had done before. So I made the mistake of not cutting, and now I'm just waiting for the time to see how I can fix the position that I'm holding, and maybe try to catch the next correction, the end of this for now 1 month bull market that we are going through. So so yeah, basically what I see now currently on the VIX is my volatility trade and trend have come down, and what I'm waiting to see what I'm going to do is at least price of VIX to reclaim trade and trend. It had reclaim and confirm trade Tuesday. Today, obviously, on the VIX crash, we went slightly below. I'm going to see what happens tomorrow, but I need to wait at least to make something on my bearish positions. I need to see the VIX actually reclaim trade and trend to see if something is going to happen. I know VIX does not necessarily equate to what's going to happen in the market, but it gives you an idea of how much risk you can take, considering that facing you have the people shorting VIX. So I made a meme about it around that proved to be wrong. But once you get VIX, the bullish and bearish, bullish trade and trend, the people shorting VIX are actually in a bad situation. So you increase your chance to have a big move on the downside when markets finally sell, because people are going to chase puts, and the people shorting VIX are going to be in trouble. So for now, we are not in this scenario. Price is still below trade and trend. We need to reclaim it, at least to have some chance of seeing some volatility spike, or at least to have a chance to have an acceleration on the down move on assets. Okay, so that's the first thing. I was wrong. I should have cut the positions there. I didn't, and now I'm trying to fix the situation I'm in. So I'm going to go to US 500 now. I'm watching cash. I like to watch cash. Okay, I'm gonna go there. Okay, so my mega sell signal triggered. I posted it the last time. The track record is pretty good on this one. It triggered, I think, on last Friday, I believe. And usually what you get when this happens is a continuation to a start of the down move. For now, it has not happened. I mean, you had the small correction, but they are still holding trade. Okay, you saw today they refuse to see the sell continue. They try to buy the dip at trade, and for now we have no confirmation. We have to wait to see what's going to happen. You can see here volatility, which is blue, of US 500 is still below trade. What we want to see is volatility to climb back up above trade and to start trending higher. For now, we don't have this, so the bull market is still on. The bull market that started around that time, and that got the confirmation at the end of May because the VIX refused to do what it used to do before. Matrix has rolled over. This is good. The problem is we now need to see what the price is going to do. So for now, still no confirmation. Same situation as with VIX. We have some hints that something may be started, but for now it's not going the bear's way. Nasdaq looks pretty much the same on the run up. Got a lot of mega sell trigger that had no follow through. Today they defended trade and reclaimed it, so nothing happening there. Matrix has rolled over too, but no sell-off so far. Volatility is starting to pick up, but nothing significant. We want volatility to start trading higher to see a sustained move to the downside. And for now, same as for US 500, it's not happening. So yeah, that's why actually I'm trying to remain on the sideline, because I mean, I don't see any confirmation yet. Also, the signals are starting to manifest, but trying to time the top in a so-called bull market is very, very difficult. CAC don't look the same. So CAC actually, CAC volatility is starting to pick up. We had a top on the 21st of April, and since that day, the volatility are starting to go up, and we had the trend change on my fractal range and also on my system. Now we want to see the blue line here, volatility continue to go up. Matrix has rolled over, but yeah, I guess European indexes are still waiting to see what's going to happen with US indexes. Another interesting signal is DXY. So these past weeks, we've heard many people mention that okay, the sell-off in dollar has started again. They have mentioned the fact that Powell is pausing and Christine is still hiking, so you need to go long euro, short dollar. I would say that for now, the signal is not agreeing entirely with this idea. So 1 month ago, when I was there, I mentioned that we would have a volatility bottom somewhere around here. So this is what we got. We got the top. And what we wanted to see is trade actually reclaim above trend. This is what we got. This is actually a very good sign. This is usually very bullish. Now, of course, if volatility started to pick up and break it, it would be another matter. But for now, volatility is holding below its trade and trend, and the price action, the price of DXY is above trend and trend. This is very bullish. So also Matrix has exhausted, Matrix Daily has exhausted. I want to see what happens on the turn, but for now, if nothing changes, I would expect DXY to hold and to start finally start the move up that we have all been waiting for. So we're gonna see. I'm gonna see what happens with Matrix, but for now, it seems to be holding bullish trade and trend. In my fractal range, I know that it's neutral, sometimes bearish because it's really on the line. But regarding volatility, for now it's holding. Okay, so more information on this, I would guess next week, once we have Matrix bottom. Let's go to gold. I know a lot of you are trying to buy gold. So last time I addressed this topic, so 1 month ago, because Bryan had the short position on it. And I mentioned that the good time to take the short off would be when we reach this kind of volatility. So we are definitely there. The trend has shifted to bearish. So it confirmed on the 9th of June. Since then, it started to roll over. But we've seen that before. We've seen that here in March, and we are seeing that also in June. So people who are short, I hope they took off a bit today. For now, the bottom is a little tricky because Matrix has not bottomed. like you had, for example, in February leading to March for a potential buy. Matrix is still rolling over, so maybe the bottom could come a little later. Okay, so I actually took a very small position to monitor gold today, but I'm waiting for Matrix to confirm the rollover on daily to start going in, maybe as a counter trend bigger position to take later on. But for now, I would not go big in gold yet. Volatility is picking up. You can see here it broke here the trade. It hovered around trend and confirmed finally the break. So MFR is bearish. I am bearish also on my volatility trend signal. So yeah, that's for gold. Interesting was I got actually a buy today on platinum. Let me yeah, mega buy in platinum. Usually platinum is will trigger in advance. So you get to trigger in advance for platinum, and several days or weeks later, you will get the same in gold and silver. So that's why I'm starting to monitor more closely precious metals. And you can see platinum is also bearish, right? Silver is the same. Silver is bearish. It's been bearish, confirmed on the 19th of June. Since then, it's rolled over. Volatility is going higher. It's trending higher. And Matrix says we are not there yet, right? You can see here, it's just going lower and lower. So same thing. I would recommend patience. Don't go crazy on those. Ethereum and the Bitcoin were actually quite interesting. I got a buy signal on Bitcoin on, let me adjust to see. Sorry, it's loading. I got a buy signal on Ethereum on the 15th of June while it was testing my volatility trend. It had a good move on the fact that it broke my fractal range trend, went to my volatility trend, sorry, held, launched a buy signal, and now it pumped, and it's now retesting trend. So I don't know what's going to happen, but for now, I would say the move up is not over. Bitcoin looks the same. It went to trend, held, and went higher. And on MFR, it's bullish trend. So for now, not daring to touch. By the way, all these indicators, this one, the my fractal range one, and this one are available for subscribers of my fractal range with more than 150 tickers in their allowance. Then going to yields. So last time, so 1 month ago, I mentioned that I was actually bullish on yields, expecting yields to keep going higher. My target for 2 years is 5%. For now, I don't see any reason to change it. At the time, it was nearly crossing, trade was nearly crossing trend, and I had target for vol at the low. And I said that trade when crossing trend would go lower and price would accelerate. So this is what we got. Trend got confirmed also on MFR. We have the cross also that I mentioned for dollar, the cross of trade and trend here, you can see. And since then, yields of 2 year is still going higher. I'm not expecting any change on that, especially now that we have JP saying that they are ready to hike another 2 times, which the market clearly doesn't believe. Let's see who's right in the end. The 10-year is the same. I think I mentioned 4% for this one on the target. For now, it's holding, not moving much, but it's holding. I mean, you had the same thing, trade cross trend, and volatility kept going lower, and now it has room. I mean, it has room. So yeah, not touching bounce. Yeah, I'm gonna stop there. So yeah, to sum up, I got wrecked not closing the positions that I have as a bear. It was stupid. And now that I'm getting mega sell signals, that I'm seeing yields potentially continuing to go higher, DXY continuing to trend higher, I'm reluctant to close. So I want to see the mega sell signal follow through. I want to see what's going to happen. I want to see the matrix rollover follow through. I have no idea regarding the fact that it will be a big sell-off or just a retest of trend. I'm not sure about that. I'm aiming for trend first, and then to decide if I see volatility starting to pick up really and trend, and to see a big move. So I am agnostic regarding that. Yeah, so that's my take regarding what's happening now and what I've done for the past month. Stop share. Okay, now Bryan, if you want to take over and mention what you see in the market, etc. If you want to address.
Yeah, sure can. I've gotten wrecked too, man. So right there with you. Let's get right into it. I'm not going to spend a lot of time today. Pretty much where I'm at. Y'all can see this okay? Yeah. Okay. Pretty much where I'm at. So for about like 2 weeks, I've had just so much confluence in terms of long-term ranges in MFR, Raphael sell signals, vol crush to the cheapest levels for the entire bear market, macro turning, etc. Like I've got so many signals right now that this bear market rally, all these bullish trends that have been in place, a lot of them for the entire year, most, really accelerating here over the last month, are completely blown out to the upside. And there's just not much left. I've had that signal for about 2 weeks. And so pretty much my book, I've just haven't really done anything. I'm short a bunch of bullish trends, a bunch of exhausted bullish trends. I'm short very few bearish trends at this point. Pretty much most of my shorts are bullish trends that I've just held for 2 weeks, gotten wrecked. Some have worked, some haven't. But right now, I'm just holding them with the expectation that this thing is going to fall apart. So that's pretty much where I'm at a high level. What's gotten me there? I'm showing you right now a watch list on my fractal range. I've got it labeled risk off. What we saw coming out of coming into June. So if we just wind the clock back here, let's look at the high beta, low beta ratio. You can look at this ratio. You can also look at defensives versus cyclicals or growth ratios. So some of those include XLP versus IWM, XLU versus IWM, XLP versus Qs, XLV versus Qs. All of these ratios got completely hammered. So we'll look at it through the lens of, let's look at actually SPLV over SPHB, just so you can really. So throughout the course of May, like healthcare XLV over QQQ starting at the beginning of May, but really accelerated into the end of May and first 2 weeks of June. They completely dumped all of their defensive stocks and chased high beta stocks. So it wasn't just a matter of them selling high beta and low beta. They sold their low beta to start chasing defensive stocks. And that signaled just a huge amount of risk on, which has led the broad rally that we've seen heading into June. What started to happen as that selling got very intense was we started getting big buy signals on Raphael's signals. And in that with confluence, we got upside caps on things like high beta, low beta. So this spread, for example, was capped to the downside. We had caps on XLP over QQQ. Staples were oversold versus NASDAQ. Healthcare oversold versus NASDAQ. Value oversold versus NASDAQ. Utilities oversold versus IWM. TLT over QQQ was even capped to the downside at one point, and I think that one's actually, it had a bad day today, but it's chopping sideways. Nonetheless, all of these things were capped. We also got an upside cap, and just so everyone knows, a cap is when you have both the near-term range and the long-term range at the same level in MFR. We had it on QQQ, we had it on IWM, we've had it on KRE, so regional banks. Those have broadly gone sideways since the event, and now they're capped to the upside. We got so many freaking caps. I've never seen it before in my life. XLK was capped to the upside. And so we had these caps right into, if we look at the chart of Qs, like they started showing up pretty much the last week of the squeeze. It started going higher. The caps were moving higher. I get it. But in general, like this bullish trend is completely exhausted. So now starting on Monday, so from last Friday when we started selling, the caps got released broadly. So the upside didn't necessarily open up, but the near-term ranges started shifting lower within these. So if we look at like what the long-term upside downside ratios are, it's still completely garbage on high beta, low beta. And it's not completely capped, but it's pretty close. Clearly, there's a lot of excess long-term downside. Same thing happened on Qs. Not completely capped anymore because it started going down, and this is refreshed as of the close today, but still a very tight window up there. IWM is still capped to the upside. That one's still completely in place. No excess upside beyond its long-term range. XLK, same way. SPYs is even starting to tighten up a little bit here, pretty tight up there. So if we look at like my macro dashboards here, this column right here, I add this one in to try to track where these caps were. And so like, let's just go through the numbers here. SPYs, 1% excess upside. Qs, 1% excess upside. IWM completely capped. EM, not even looking at China, capped. XLY, 1% upside. XLK, XLI, XLB, all not excess upside. Continuing on. Oh, and dollar, that signal's improved a lot. That excess upside has opened up as today UP went back to bullish trend. So that's a positive there. IGV capped to the upside, URA capped to the upside, XRT capped to the upside, KRE still capped to the upside. High beta itself, so the low beta ratio opened up, but if you look at just straight SPHB, this one has 0% excess upside, riddled with mega sells from Raphael. Even today, the mega sell released and we closed red on the day despite them trying to save the index. So high beta is still underperforming on this recent turn here. The Hearst exponent is high. If we look at high beta, I think I've got it on the watch list here. The high beta low beta ratio, that one is high. If we look at SPHB itself, it's Hearst exponent 0.69, so not 0.7, but still solid. So that one should just continue trending lower here. You've got volatility getting extreme on your signal, Raphael. Hourly isn't oversold. It just chopped sideways today. So I would expect that one to dump. It couldn't reclaim higher. Going back through the list here, IJH, which is mid caps, IJR, which is small caps, those are capped alongside IWM. OEF and Qs, like I mentioned, not much excess upside. IWF capped, IWO capped, quality, not much upside. Russell value capped. China capped, Japan capped, the darling that everyone loves, that they're long Japan, but they're not long NASDAQ and they're gloating about it. That one had a bad day, but you didn't want to talk about that. So that one's capped. I'm actually really heavily short Japan just because of how much freaking everyone loves it, wants to buy it. So capped to the upside, China capped to the upside on all three ETFs. So that one's about to get whacked. EM capped to the upside, South Africa capped to the upside. So I've never, ever seen this many macro ETFs capped to the upside MFR. Like these bullish trends are completely exhausted and this thing is going down. It just is. So like I could mess around up here and try to, not take a down day like today because they crushed vol down to the 12s. But we all know where this is going. There's a ton of excess upside. Everyone's listened to Jem and all the vol guys talking about how all of this excess call buying squeezed out the shorts and puts at the end of last OPEX. And now the vol down, stocks down action you're seeing is a function of them selling calls. So like, yes, like SPYs closed red today, but VIX got whacked into the 12s and S&P was up like what, 30, 40 bips or something like that. 36 bips versus VIX going down to the 12. So a large majority of this was call selling and positions just being cleared up. So it's just like vol is so cheap. Any wink of the sun could completely crash this thing and people would be able to buy cheap puts with a snap of their fingers. So a big spike is coming. It's coming very aggressively. I don't know when. It could be tomorrow. We've got PMI reports coming, but but it's coming. So I just have a book. It's down. It's not great. But I know the setup. I've never seen this much confluence in terms of exhausted bullish trends. I know the macro is bad. It's starting to turn, and I think we should go for it. So that's where I'm at from a quantitative perspective. Just to add on a little more, just to really kind of drive the point home here. So I showed you all the macro ETFs capped, but there's a ton of individual stocks that are capped too that I'm short, like XHR, Dillard's. I already talked about China, but all these ones that are red here in this column N, those are all capped to the upside. It's really bad. Like I've got a ton of bullish trends here that are just like begging to be shorted. And there's nothing better than a short that's a bullish trend, because you can short it when it's a bullish trend, and then it's going to transition to bearish trend and completely get destroyed. So I like shorting bullish trends here better than bearish trends. One, because like, if you're short a bearish trend, probably half the downside is already done. And so the bounce will be more violent on the bearish trend because you'll get oversold, puts will get bid more quickly, and then bounce goes. So like when you're trying to short a top like this and just hold and let the actual volatile breakdown begin, you short the bullish trend that's exhausted to the upside. It drops slowly and then it will start dropping quickly. Japan specifically, I mean, short that thing right now. If you look at EWJ on Raphael's signal, it just chopped sideways today as the matrix reset lower. It broke daily trade. Nikkei, who's everyone talks about as if they're long, that one's still overbought and it's just waiting to drop as well. So these things look great. I like the shorts here. Let me talk a little bit about macro. So it's really interesting where we're at right now. I think like from a macro perspective, clearly the Fed hiking more rates isn't breaking the market. And why is that? Well, like broadly, the reason that stocks have bounced this year and were supported out of March, partially because puts were bid up in March and the Fed, went loose right out of the banking crisis. That was one reason. But the other reason is because like we're not in recession, and people calling for recession all last year, all the way up until December. Everyone got positioned for recession. It didn't come. And then they've completely unwound those positions now. And so now, like, obviously the stock market isn't positioned for a recession. But I would say the bond market isn't either. A lot of people talk about like the forward futures and what they're bidding in terms of the, implied vol on different euro dollar curves and whatnot. I'm looking at this 6 month minus 2 year spread. And like once I started thinking about bond yields just in terms of the 2 year yield is what the market thinks the Fed funds rate is going to be in 2 years. If you just think about it like that, this is a lot more straightforward. So 6 months, so that's going out to January. And if you look at the 6 month yield itself, that's at 5.4%. So the 6 month yield is saying that there's going to be another 25 basis point hike, at least one 25 basis point hike this year, probably. And then if you look at the 6 month minus the 2 year, so that's going to be the difference between where the 6 month is right now versus the 2 years right now. So that's 61 basis points of cuts. So the market only thinks that between January 2024 and June 2025, the Fed is only going to cut 60 basis points. And so that tells you that they don't think this recession is going to be that bad. They don't really think there's going to be a real recession at all that would force the Fed to start dropping rates within the next 2.5 years. So what I'm looking for now that something like the housing market, so if you look at like the NAHB, which is a really good indicator of the housing market, this one bottomed with stocks back in December. That one's bounced consistently throughout the entire year. And that's led to inflation remaining sticky and has led us into now having a positive stock bond correlation. If that starts to roll, we're getting into a scenario more where growth is slowing. And I think where we're at, like I mentioned, with like the 6 month year minus the 2 year, I think that we need to start pricing cuts. Because if you look at how this behaved through 2022. So we were dropping into the early 2022. And then when inflation really started picking up and we started pricing in more rate hikes for the rest of this year, the forward expectation for more hikes continued rising. Initially, they were looking for cuts across the zero line. And starting back in November, so November, October, the bottom in the stock market, this one has gone positive, which means that the bond market is expecting on a forward-looking basis over the next 2.5 years from each of those increments, more cuts. And so this has consistently risen, which makes me think that in order for the stock market to drop, especially back towards the lows here, we now need to continue rising to the point where the macro is bad enough for us to expect more cuts. So you look at like what this one did back in March on the SVB event, it started, going pretty consistently, especially look at like the 6 month minus the 1 year. That one really dropped because they thought the Fed was going to start cutting aggressively too. And so I'm looking, in order for us to get a real equity sell, like I think this one needs to go. I think we need to get a spike in this curve, and I think rate cuts need to be priced in, which I think would send the stock bond correlation negative. And like what you saw today on jobless claims, I guess not spiking enough to scare the market enough at this juncture. We'll see what happens tomorrow, but stock bond correlation softened today on the equity up move, which in itself I would consider to be bullish, but clearly they don't care that the Fed wants to hike 2 more times this year. I think that stocks need macro to not be bullish, and macro, quite frankly, has been bullish for the entire year. So yeah, like going into PMI reports tomorrow, I think the best thing for the market is going to be really bad PMI reports. And I think that those would pressure yields, at least initially, and then pressure stocks. Whether yields get held down on that, I don't know, because the bar is very high for Jerome Powell to get cut, so to actually cut rates. So it's like you're in the scenario where the macro needs to start coming in bad in order for stocks to drop, because Qs actually have rallied on good growth, not necessarily rate cuts at this point. Initially, they were rallying on potential the Fed wasn't going to hike into oblivion, but now they've rallied actually on good growth. So you need growth to noticeably slow. We've seen some things, some of the PMIs are softening. Jobless claims are starting to rise slowly. And so we need the PMI reports to be bad tomorrow in order to pressure stocks. And where we're at in terms of everything I've talked about with bullish trends being exhausted to the upside, everyone is long, vol is crushed to the actual complete lows. The worst thing for this market right now would be very clear recessionary data. And it's time for some of the macro gurus who've been calling for recessionary PMIs and everything for the last year to maybe start being right. So whether that's the real recession, I don't know. We'll have to find out, and we'll have to see how things start to trend and how signals change. But what's one thing that's been like very stable through a lot of this move has been the trend skew on yields. So if you look at like the 5-year, US 5-year, US 2-year, they have gone back to bullish trend. The upside has opened up, but the skew has been broadly pointing lower. Like we're not completely heavily skewed for more upside in yields. So the setup right now is actually very similar to how it was going into the SVB event in March, where we had high correlation risk with stock bond correlations being positive, sector correlations improving, yields rising and looking like they're going to rise more, but you get some kind of event that smashes yields and then hurts stocks. So I think we're going to get some kind of thing like that. I think we're going to get some deflationary risk off. You see oil getting absolutely cratered on today's jobless claims numbers. So oil is clearly saying that growth is slowing. The Russell was down today. Cyclicals led lower. So yeah, I think it's deflation, and I think there's going to be a risk off event, mainly because of where all of these trend skews are. Everything's just so exhausted to the upside. So yeah, I'm neutral. Like stock bond correlation is positive. So in theory, more rate hike expectations should be bad for stocks, but clearly today, that wasn't the case because jobless claims came up a little bit. Bonds got whacked. So that means that there's more rate hike expectations. Powell said they're going to hike 2 more times, yet stocks rallied. So I look for these correlations to maybe flip negative here in the near term, but I don't know. I don't know how it's all going to play out. I think the biggest thing for me is just how exhausted these bullish trends are, how much downside is in these trend skews, how many names I have capped to the upside, how many sell signals we have on Raphael's. Big ones like LQDH, for example. This one's topping out, credit spreads, HYGH, that one's rolling over on your signal. High yield OAS, that one's actually spiked and recaptured daily trade right there with matrix turning higher. So there's a lot of things there for like credit spreads to blow out and some kind of event. Regional banks capped to the upside, having a really bad day today. Gold, looking the potential that it could bounce. Gold, actually, I wouldn't buy it long here because it'll probably get liquidated in some kind of event, but we could easily see some kind of bounce in gold like we did in March as well. If you look at like alongside the yields having skews lower, gold, for example, today, it just tightened up as well. Like it's not capped to the downside, so don't get me wrong here, but the long-term upside, the long-term ratio in gold is actually very good. And its Hurst is low. So this isn't some kind of big trending move in gold. So I don't know. This market is just begging for something to happen to crash it. PMIs tomorrow, hopefully they're bad. They've been consistently bouncing most of the year. So, talking about deflation all year long, totally wrong. These have been US manufacturing PMI. That one's actually been sideways, but like the big one is services. So like ISM services, that one's been bouncing, but starting to roll over. ISM services employment rolling over. So, yeah, I think the market needs recessionary data to crash, and I think we could start getting it. I think now's the time to start getting it. I would watch this 6-month minus 2-year yield because that'll tell you like very quickly in real time, like what's like the real thing going on in terms of pricing the potential of cuts going forward. I think that could bounce here. So that's what I got, Ralph.
Yeah. Okay. We shall see. I mean, we have a lot of indications, at least signal wise, regarding potential top either being already in or will be there just after. And we shall see. I'm actually
one more thing I forgot to mention. I want to call out this QYLD ETF that I talked about, and I'll loop in with your vol signal on it too. So I found this one, someone posted on Twitter about it, and I started looking into it. I was like, oh, like this one has really regularly called some key tops. And so basically what it is like the ETF is long Qs and then it's short calls above to kind of hedge it out, and it gives it like actually a pretty nice little dividend. So I wouldn't mind actually going long this one in the bull market, but like your sell signals have been very clear on this one. Like when it stops going up aggressively and starts to flatten out, that's the point where you're getting like stocks up, vol up, and people are chasing calls to the upside. So being short calls and long stock doesn't really work out very well in that scenario. But if we look at your volatility, there have been a few very key junctures. I did it going all the way back to 2018, which is where the ETF goes. And so there have been points where your daily volatility reaches like a very key juncture and has gotten low enough that leads to some kind of vol event. The last time we had it was September 21. We got a sell. We went back there in November and then consistently started selling. We got it in February 21, February 2020, October 2018, January 2018. We actually didn't really get it throughout all of last year, but it did align very well with when the green lines are when we got your spikes in volatility, when trade got above trend. And so it aligned very well with that. And you get the sell signals kind of before then of when the selling really started. And so that's just another thing to call out. That one reached that level. It gapped down 2 days ago. We had a big bounce today. good for you. But, you know, we're not above your hourly trade and we're not above your daily trade. So this kind of thing, I've been looking back, like it happens each time. Like, so if we look back at all the ones with the orange here, we gap below trade, come back and test it and then sell. Gap below, come back, test it and sell. Gap below, I mean, that was the 2020 crash. That one just went. Gap below, test it, gap below. So like we're following a pattern right now, and it gapped, but it did the test a lot faster than normal. So the test was, I guess, today. So I think this one could go as soon as tomorrow. It could get back on track. So I would look for this one to continue going. If it doesn't, I'd be surprised. So
okay, we shall see. I mean, for now, I'm just waiting for a lot of stuff to be put into place. We obviously were wrong, so we should assess why, and yeah, maybe be more patient. I don't see any questions in the chat. If you have any, please send it now. And if not, okay. So some single stock moves have been interesting to the downside recently. Good companies with good recent updates. He give an example, SSP Group, but down from 280 to 250 in the last 10 days. Makes me think it's being priced for recessionary environment or downturn at least. Okay, so Bryan has already addressed that. I'd rather like we stop trying to say if it's going to be deflation or recession or etc. Obviously, we tried to time it. It didn't work. So now I would like to focus on the signal-based stuff. Like, okay, we have the cap. For example, VIX lower range is starting to go up. We have this kind of stuff. And we're gonna see. I mean, obviously, the people disagree with our view because the market is going higher, and now we just have to wait to see when people are gonna price either because of some event, could be geopolitical, could be maybe a big sell-off in bonds, could be so of course recessionary data, but yeah, I mean. Look at NVDA. Does it price in a recession? I don't think so. So let's see. Let's be patient and let's see what's going to happen later on. Any last word, guys?
what's the bet?
Any last word, Christopher?
No, nothing.
Okay. Nat gas still bullish trend in 2 weeks.
Who cares about nat gas, man?
Yeah,
So
okay. The problem is we do VIX, we do this kind of stuff, and
do gold.
Okay.
Gold.
Okay, what do you want for gold?
Is gold above 1965?
No.
In 2 weeks.
No.
I'm gonna say yes.
I must say no as well.
Okay. So yeah, we should see in 2 weeks. Okay, guys, let's wrap this up, and yeah, keep in mind sometimes we are wrong, and the best thing to do is to reassess and to see what's going on. For sure, a good lesson for the past, I would say, month and a half was the signal is much more important than the macro. Okay, so listen to the signal first, and don't be impatient to short the rip like it was last year. Last year was much easier. Now, for sure, the volatility structure has changed. So nailing the top, either for a small correction or big one, will be much harder. Okay, so I want to thank Christopher and Bryan. And next week, Vi will be back with some other guys. So obviously we are approaching summer, so it will be much more difficult to assemble everyone. I will go on holidays also for 2 weeks in July. I guess the guys will have also some days off, but at least Vi and some of the other guys will be back in 2 weeks. So let's hope for sell-off, especially considering my positioning. But yeah, let's keep open. See you guys.
All right. Bye.